Hi, everyone. Welcome and thank you for joining us today for our session focused on California's climate disclosure laws. So California has stepped into a leadership role on climate action with the introduction of SB 253 and SB 261, two landmark regulations that are reshaping how organizations think about transparency, accountability, and long-term resilience. So these laws aren't just compliance requirements, they really represent a broader shift towards a more sustainable, future-ready economy. And for companies, this moment really represents a rare opportunity for us, a chance to deepen understanding of climate-related risks, strengthen operational strategy, and build trust with our customers, investors, and communities. And by leaning into these changes now, organizations can position themselves not just to meet new expectations, but to really lead with clarity and purpose in this rapidly evolving landscape. So we're excited to delve into this a little bit more here today and share some practical tips and next steps on how to best prepare. But before we dive in, just some quick housekeeping items to share on how to navigate this platform that you're currently on. Please feel free to type any questions you may have throughout the presentation into the Q&A box located on the left-hand side of the screen. We have a lot of time at the end of today's session to answer these questions, so as they pop up in your head, feel free to pop them into the box. In the toolbar, you'll also find a short survey for today's webinar experience, and we kindly ask that you take a moment to complete it at the end of the session. If you do have to leave the session a little bit earlier, please feel free to fill out the survey before you go. And you'll also notice a collection of resources linked below the slides today for you to access, in addition to our featured content. So feel free to peruse those links when you get a chance. And should you wish to connect with a Cority expert to learn more about what we do here and our EHS Plus software solutions, we invite you to submit a demo request via the widget on the bottom left. So a quick introduction to the faces you see on the screen here. My name is Isha Varma. I'm the Product Marketing Manager for our environmental and sustainability solutions here at Cority. I'm based in Toronto, Ontario, where it's getting colder and snowier by the day. But I'm excited to be with you all today as the moderator for our presentation. And with me, I have our main speaker and star for today, Connie, who I'll hand it over to now to do a quick introduction and kick us off for this exciting discussion. So over to you, Connie.
Thanks, Isha. Welcome, everybody. I'm Connie Prostko-Bell. I am the Sustainability and Resilience Principal here at Cority. I have been in the sustainability space for many years, beginning my career with the National Oceanic and Atmospheric Administration, developing the global greenhouse gas inventory. We'll look at this a little bit later, but many of you are probably familiar with the so-called Keeling curve, tracking global emissions, and the lab here in Boulder, Colorado produces much of that data. And from there, I pivoted to the private sector to help companies really realize the promise of sustainability and how sustainability, resilience, and prosperity are all intimately linked and certainly not mutually exclusive. And so I'm really enjoying the opportunity here at Cority to help our customers to drive sustainable performance and realize those business benefits. So I think we can go ahead and get into our agenda. So we will go over, we're going to move through a lot of content. As Isha said, feel free to ask questions as we go along. But we'll start with a little bit of sort of some foundational information about the California regs and the history of those regs in the state and the intent of those regs. Then we'll get into the latest updates. We'll look at implementation timelines, help you to understand hopefully what impacts your company. There's been a little bit of a change in that with the most recent updates. Nothing super significant, but, depends on who you are, I guess. But, and then also looking at kind of the more global trends, also other trends within the United States and kind of what you should be thinking about in terms of those no regret metrics to move forward with establishing or enhancing your own sustainability performance program. All right, so starting off, when we think about the California Climate Accountability Package, what we'll talk about today is focusing on sort of the more recent developments around SB 253 and 261, with the assumed integration of SB 219, which modified those two a bit. And part of the climate accountability package that we won't be getting into today is the Voluntary Carbon Market Disclosures Act. But if you do have questions about that, feel free to reach out to us. All right, so again, just like I said, we're going to do a little bit of fundamental. This is probably super familiar to many of you, most of you maybe, but maybe just for some of you that may not be super familiar with this diagram, thinking about scope 1, scope 2, and scope 3, and it's relevant both for SB 253 as well as 261. So scope 1, thinking about anything that's kind of coming out of a tailpipe or a stack or a generator on your physical sites. So those things where there are direct emissions coming from your operations, and that, but also it could include mobile sources. So it doesn't necessarily need to be on your site, but if it's a truck that you own for where it's going. So those are kind of the scope 1 emissions, probably, fairly easy to measure. Most organizations have the data that they need to develop those inventories. Scope 2, again, somewhat easy to measure because those are your indirect emissions that come from purchases from utilities. So I don't mean easy in terms of collecting the data because maybe you're a global company and you have sites everywhere, and some of them you're just leasing a space and maybe it's only a floor in a building as opposed to some others where you have the whole site. So from a data collection standpoint, it can be complicated, but from kind of understanding that impact, it's a little more straightforward. Then maybe your scope 3, which is also indirect, and that's looking upstream and downstream. So where there are things that you're purchasing, such as capital goods. So category 1, capital goods and services, is a big one for most people. Downstream, where you're thinking about transportation or end of life of your products. A lot of times we hear people say, well, we have no control over those. And it just depends on what industry you are, because you can certainly have control over those. So just as a really simple example, if I am a car manufacturer and I am, producing a car that has certain emissions, I do have control over what that scope 3 use of product emission footprint would look like. So again, it just depends on upstream, with your purchasing decisions. So there is the opportunity to control scope 3 emissions, again, depending on the specific situation. We also hear a lot around, well, isn't that double counting? And, there is truth to the idea that, your scope 3 is someone else's scope 1 or scope 2. Absolutely true. In terms of double counting, though, what it really is doing is giving you that perspective of where your risks and impacts lie. Double counting might matter if we were, if there was 100% of something, right? And we were all adding up to that. But that's not really how that works. It's really just to do an accounting of the specific footprint of an individual entity. So it doesn't mean that, well, because I'm counting it and then my supplier is counting it, then in some grand accounting scheme, those are double counted. It's not really relevant from that perspective. So thinking about what the point of these policies are, it is certainly not to make people's lives difficult. Overall, we are thinking about what it means to increase greenhouse gases in the atmosphere and how that impacts not only the stability of certain climate mechanisms, but also how that poses potential risk to your organization. So thinking about the molecules that we saw in the previous slide. So basically, there are more so-called greenhouse gas molecules, but what we're focusing on both from the GHG protocol and the IPCC is those 6 or 7 key molecules that possess the so-called radiative properties that account for the greenhouse effect. And of course, the greenhouse effect is a great thing, right? Everybody probably learned in high school that without the greenhouse effect, we wouldn't have things like liquid water. And also we wouldn't have people because it would be too cold here for us to live. So what that does is it puts this nice little blanket around the atmosphere, and those bonds that hold those molecules together, they vibrate at a certain frequency that aligns with the wavelengths of sun coming in and warmth going out. And so it holds that heat. And that's great to a certain extent. But then once you start throwing more and more and more and more of those molecules into the atmosphere, you're trapping more heat, and that drives not only global ambient temperatures, but also climate mechanisms. And so it's important to understand and to be able to control, that level. So as I talked about before, this is what we're seeing here on the right-hand side is the Keeling curve, and that is measuring since the Industrial Revolution, the level of greenhouse gases in the atmosphere. And so what the Climate Accountability Package is really trying to do is to ultimately limit those impacts of enhanced global warming and to understand where there are opportunities to reduce those impacts, and also to give investors and customers, consumers, that level of transparency into where a company might be exposed to certain climate risks that are a result of this increased warming. And so that's a really important thing for a business to understand, not just for the sake of reporting to the state of California, but generally for their own risk management. And so when you think about what these policies have done, so California has really been sort of in the business of looking at climate for a long time. And since 2000, so for a little over 20 years, they have managed to reduce GHG emissions by 20%, while their gross domestic product has increased by 78%. So we can see there that, again, these activities, these actions don't kill economic activity. They don't reduce prosperity, but they do make it sort of cheaper and easier going forward, where we're not dealing with a lot of these extreme climate-related risks. So they've also managed to decrease the carbon intensity of their economy by 55% over that time period. And when we think about carbon intensity, that's basically normalizing carbon emissions by GDP. And so even with your own organization, you may look at your carbon intensity from either a revenue standpoint or a per widget, whatever you're producing standpoint. So there's other ways of looking at that that help you to consider and to communicate where you can have that opportunity to reduce those impacts while still allowing growth within the organization. Now, of course, the atmosphere, from an absolute standpoint, that's all that the atmosphere cares about. It doesn't really care about an intensity, but it is a useful measurement for companies to be able to assess and really look for those opportunities for impact reduction, risk management, and opportunities to innovate. So kind of what's the situation currently? This saga has been going on for about 2 years now. We'll talk a little bit here about the enforcement notice that CARB issued about a year ago now in December of 2024. This is really important because what that came out to say was essentially like, look, we are expecting a good faith effort. We want you to try. We are not here in the first 2 years of of the implementation of these regulations. We're not here to be out there penalizing people or assessing fines or otherwise causing problems for your organization, but we want you to give it a good faith effort. The other reason that enforcement notice is important is because as of the last update, the third workshop from CARB, we now understand that if a company had not, prior to the enforcement notice, been collecting Scope 1, Scope 2 data or Scope 3 data, then they are not obligated within that first reporting period under 253 to report. So in other words, they will not have to report what is now, I think, an August 2026 deadline on 2025 data. They will be obligated in 2027 to report on 2026 data. Again, if they had not previously been collecting that information. So another recent happening is that there was a preliminary injunction issued by the Ninth Circuit Court of Appeals in California to stay 261, which is the climate risk disclosure that was the deadline for that was supposed to be January of 2026. The plaintiffs asked for the court to stay both 253 and 261, but the court declined to stay 261, but did, because that deadline isn't until August of 2026, but did stay 261 while the appeal is pending. So we'll see where that goes. Probably, the expectation is that it gets hung up for a while, but but again, that kind of remains to be seen. And that is a result of a lawsuit brought by Chamber of Commerce et al. There is another one in parallel currently in the Eastern District of California from ExxonMobil. They're looking to change venue for that, but really both of these lawsuits their main complaint is that this is a First Amendment violation of so-called compelled speech. So where the state of California is asking them not only to post this information, these disclosures on their website, California or Exxon actually takes it a bit further and says, well, we disagree with the methodology of the GHG protocol, which 253 asks for alignment with. And this is basically meant to kind of embarrass large companies and blame and shame them for greenhouse gases or for climate change. So, we'll see where that goes. We could see something soon on that. I would expect eventually both of these to probably get to the Supreme Court. So interesting to watch as these move through the courts, and something certainly to keep an eye on. However, it is important to move forward, and we'll talk a little bit about that regardless of kind of what's happening specifically in California. And we'll get more into that later in the presentation. All right, so how do I know if I'm impacted? Some things definitely haven't changed since these regulations were first proposed. And that is the revenue thresholds. So 1 billion in consolidated revenues, consolidated meaning your global revenues, for 253 and 50 million for 261. That has not changed. Now they are kind of moving around a little bit with what that might look like in terms of the entities' revenues from year to year. So we'll talk a bit about that, but this does cover all US-based entities, so formed under US or other state laws. Now that doesn't mean that foreign companies aren't subject to it. It depends on how their subsidiaries and their operations in the United States are legally structured. So if it is a subsidiary, but it's still formed under US or state laws, but it is foreign owned, then it would still, they would still be subject to this regulation. So doing business in California, that as long as you've triggered those revenue thresholds, again, there's been a little bit of change with the last review that CARB has done and presented in the third workshop, where they are basically now kind of focusing on those, whether or not, you have that physical asset, or that those revenues, they're not going to necessarily count where there are, the doing business in California isn't necessarily going to be triggered by whether or not if you just have commuting employees, for example, in the state. So it is more around that sales in California above this current 2024 figure of $735,000. Now that will be adjusted every year, but also or organized commercially or domiciled in the state, in addition to meeting the revenue thresholds. And they are just probably know this, but using the revenue and tax code. So this is established precedent within the state of California, and that is 23101, in case you need to look that up for both. That is the definition that they're using with some tweaks, as I already mentioned. Okay, so applicability and timeline. We've talked about applicability. So as I mentioned, 261 has currently been stayed, so that January 1st, 2026 deadline no longer applies. And TBD, depending on when that litigation moves forward. Then with 253, we are still looking at that August, and that was actually updated from June to August in CARB's last workshop, which again took place last month. So there is a lot of information, and we'll have a slide that we won't talk through today, but gives you, if you get this, look at it afterwards, gives you access to those different tools and information that CARB has made available publicly, including a slide deck from that last workshop. So again, with So since 253 is still in motion, we are looking at a 2026 reporting deadline for that 2025 data, with the exemption of what I mentioned before, based on the notice of enforcement. So if you were already collecting data, but if you weren't, then you have until the next year. And then, of course, the limited assurance and reasonable assurance will kick in 2027 and 2030. Limited assurance basically being a review of a sample set of your data to make sure that you were following the correct protocols, you were including the things you needed to, your boundaries make sense. Reasonable assurance is a much more vigorous process, looking through it kind of like basically every data point. So it's important when you are thinking about compiling those inventories that your data is traceable and it is auditable, so that you are prepared for when that becomes a requirement.
Okay, great. I will jump back in. Thank you for setting the stage, Connie. So with this context in mind, we just wanted to do a quick pulse check with the folks in our session today. So you should see a poll on your screen now, and we're curious to know on how you expect these regulations, based on what Connie's just mentioned, to impact your reporting or governance processes. So do you expect significant, moderate, or minimal to no impact, or are you just unsure at the moment? So we're curious to hear your thoughts. Feel free to submit your responses now. We'll give it just about 20 seconds. All right, I see some coming in. All right, final 5 seconds. And perfect. Okay, last chance. All right, here we go. Okay, we see moderate to minimal impact. Interesting. Okay, we appreciate that. Connie, back to you.
Well, I think that there could be a couple of reasons for that, Isha. So if somebody isn't subject, if they don't meet the revenue thresholds, obviously will not be an impact. Minimal impact might also mean, though, that people are already reporting or collecting this data or doing the climate risk analysis, and therefore a California-specific regulation may not be a big impact to them because they're already doing that. So a couple of different ways we might interpret that data. Okay, so digging a little bit further into Senate Bill 253. Again, this is the one that is still not currently been impacted by the Ninth Circuit ruling, but essentially you're disclosing those scope 1 through 3 emissions, and first year 1 and 2, then 3 in a following year. Consolidated reporting at the parent level. So again, not only do the revenues at that consolidated level count for triggering the threshold, but you can do reporting at the parent level. Now, you don't have to. You can do entity level reporting. A lot of companies may find it easier to do that consolidated reporting because that's what they're doing generally. So if you're already doing that, then California is happy to accept that, so long as it aligns with the GHG protocol that they're looking for. And so, no need to do anything twice or to redo it in a different slice and dice. It's important that you do, and we talked a little bit about the auditing. What's going to also be important to the auditing is that operational and organizational boundaries. So in other words, how did you figure out what counts, right? Where are you drawing that circle in terms of what is included in your accounting? And so that is something that you will need to be transparent with the state for, as well as for other auditing purposes. So other entities that you may be obligated to disclose these to, they will also be very interested in how you drew those lines. The fee for GHG emissions, now this has been something that CARB has given more clarity on recently. And essentially, once they figure out what their annual program costs are, and that's going to depend on how things, they're not sure yet because there's still some unknowns in terms of who's going to be obligated and what specifically is included. And so once they have those final figures, that will be divided. It'll be a flat fee, regardless of kind of where you sit from a revenue standpoint, as long as you trigger the revenue threshold, and that will be divided by the number of entities that are subject to the regulation. There will be penalties for non-filing, and they are giving some clarity around that as well. So something to keep an eye on as that develops. There has been some disclosure so far. I expect that to probably be modified a little bit, but we'll see. And then with, excuse me, 253. Sorry, this should be 261, excuse me, but this is where we see, and again, I'm sorry, this should be 261. So this is if you've reached the 500 threshold. The other thing that when you think about that 500 million threshold based on revenue and what does that actually mean, and here's a definition of what CARB means when they think about revenue in terms of gross receipts. And so that is something that, again, is already a precedent that is set in the organization, and is something that is part of their revenue and tax code. So again, very well defined in terms of what revenue means. And so something that your accounting team can help you to determine, again, if you trigger that threshold. With 261, the state allows for reporting either in alignment with TCFD or with IFRS S2. So what should your decision be in terms of that? If you're already doing IFRS S2 because you are subject to that in other jurisdictions, and we'll talk a little bit about who's looking for that, then you may as well just use that. It is more detailed. It's harder a little bit. It's harder than TCFD, and so it's more detailed. So that, and it's kind of a broader scope. So if you are already doing it for another reason, then probably just use that. If you are not already doing it, then the TCFD guidelines, again, they're sort of more focused specifically on the climate risks. And so it would be, for your first go at it, probably a better way to go. But again, a lot of people are already using TCFD, which can get confusing because it's been folded into ISSB, but it's not the same as the IFRS S2. So we'll talk a little bit about what that TCFD looks like. And again, the TCFD also gives you sort of a little bit of grace in terms of if you can't report against one of the pillars, then you need to provide an explanation, but it gives you that flexibility. So again, if your company is already reporting to IFRS S2, or if you do have more complex risks, then that might be a better format for you to utilize. But otherwise, the TCFD, if you're just getting started, is probably the right choice. All right, so what is TCFD? TCFD falls under, and it's Task Force on Climate-Related Financial Disclosures. They had been determined to have met the remit by coming out with this guidance. So again, the TCFD has kind of gone away and been assumed into ISSB. But nonetheless, the principles stand, and most people still refer to it as TCFD. So again, falls into the 4 pillars: governance, strategy, risk management, metrics, and targets. Now, what's interesting about this is, in my opinion, the climate risk assessment is a little bit more difficult than the just the climate accounting. And one of the reasons for that is because this does include the climate accounting. So that's sort of a subset, even though this is aimed at a lower revenue threshold. But it is a little bit more involved because you are, but again, with TCFD, you can give reasons that, so we're not reporting on this, and it's either comply or explain is the principle there. So what's important though about TCFD is that you should be looking at these things anyway. As an organization, it's important to understand where your risks and exposures are, whether or not you have to disclose them. So thinking about, our physical assets and our value chain, and climate risks globally, and what climate risks do our customers face, or do our employees face, or do our suppliers face? What about our own physical assets, and how are they exposed to flooding or wildfire fires or hurricanes? And so that's a risk management exercise that every organization should be going through as we do. The data is very solid that increased extreme climate events are increasing. And so therefore it is really important to understand how that impacts your company's ability to do business on an everyday basis to go undisrupted. So we'll talk a little bit more about that. Exemptions. So the only sort of recent change here is, as I'd mentioned before, entities whose only California business is teleworking employees. Otherwise, these exclusions already existed, of course, not meeting the revenue thresholds or the definition of doing business. Insurance-related entities, so basically anybody that's already regulated by insurance departments or other state entities related to that would not have to be subject to this, and that is probably for both 261 and 253. We'll again see how that pans out. So this is, essentially your insurance companies. Government entities and not-for-profits are also excluded. So those are kind of the companies that are, so even if you, otherwise, if you do meet the revenue thresholds, if you are a nonprofit, a government entity, or an insurance company, then you wouldn't be subject. All right, so as I mentioned, there's a lot of reasons besides California told me to do this. One being that a lot of other states are working on their own or already have in place related regulations. And so if you are, and there's been a lot of effort between these states to have interoperability. So if you're doing this to, because you're obligated in one state, what you have done for that state should be usable for other states as well. Again, trying to reduce that reporting burden and make it as easy as possible. So we see that in New York, those regulations have come into effect. The Climate Corporate Data Accountability Act was passed. So they are looking at a 2027 reporting beginning there for those companies that do meet the obligation of over $1 billion and, of course, doing business in the state. And then they have the one that 3697, which is similar to the 261, which is the climate-related financial risk reporting. Now, one of the things that California did do for this pass is to kind of back off on both TCFD and IFRS S2, ask for a quantitative breakdown, so a financial risk. So you have to, where you find those risks, those material risks, also give a quantification of what that risk looks like in money terms. With California right now, they've kind of backed off and said that just needs to be more of a qualitative assessment for now. We'll see where that goes in a couple of years. But for New York, they do want that that quantitative financial risk in addition to the qualitative. For New Jersey, it is for New Jersey, Illinois, and Washington. These are all bills that are currently moving through their state legislatures. So something that's important to keep an eye on as they progress. Each has made it through obstacles to this point. So we'll see, but they're not moving at breakneck speed. So we'll see where those go. Something to keep an eye on. Now, globally, also, there is quite a bit of activity, and this is, in many cases, regulatory mandatory obligations. And so with this is more akin to the 261, so those the climate transition plans. So again, the TCFD or the IFRS S2. Now, a lot of these countries have adopted IFRS, and so you would want to, or you would need to adhere to that framework for your climate risk disclosures. Australia is an example. Japan soon will have that as well. So countries that have adopted IFRS, you will have to conform. Others where there isn't necessarily that TCFD may be adequate. So it's just going to depend on the jurisdiction and, again, whether or not you trigger those. So point being that even if California, depending on what may or may not happen there could be other compelling reasons globally to your business that you need to do these from a regulatory standpoint, and as we already mentioned, also from a business risk standpoint. And so what are those business risks? So thinking about insurance costs, for example. So this is, again, data that is US based, but this is true globally as well. And Deloitte put these to get these this data together that it's super interesting. So looking at the 10 highest risk states this is a list from FEMA, and looking at the various climate risks in those states, and then corresponding to what that looks like from increased rates of commercial insurance. And so, the chart to the left is going to be that physical risk to your assets or to your customers, which is going to disrupt business continuity. Like if your customers are subject to these things, they're not going to obviously be buying your product. If your employees have been impacted or displaced by certain natural disasters, or if you have operations that, if you're agriculture or people are working outside, construction, then, heat stress is going to impact the productivity and if it's 120 degrees outside, you're going to have a hard time having people working outside. And, or if you have warehouses, we saw this happen with Tesla that aren't climate controlled, and it gets super hot outside, then it's going to get even hotter inside those warehouses, and people aren't going to, they're going to be, at physical risk at that point. So not only do these climate risks threaten business continuity, but they also will increase risks when you think about things like insurance coverage. So those are additional reasons to be doing that climate risk assessment, regardless of whether you are subject to that from a regulatory standpoint. Another thing to think about from a climate risk perspective is how climate changes and increased global temperatures impact ecosystem services that your business might be dependent on. So there's a lot of different ecosystem services. All are important, but some businesses depend more on some than others. So just kind of drilling down into freshwater, for example, a lot of processes rely not only on water, but on clean water. And so if you are drawing from the local aquifer, from the river, and you are operating in a heat-stressed area, and you have large needs for water to produce your product or to produce your service, then it's important to understand how increased temperatures will impact the availability of that water in heat-stressed areas. So this is, again, a really important reason that regardless of what happens in California, businesses need to be taking a very hard look at where their exposures are. And it might not be fresh water, it might be availability of other natural resources. And so, the ability to, it might be, you might be a pulp and paper company, you may be dependent on forest resources that are going to potentially be severely impacted by climate risks. So again, things to think about. This may also impact logistics routes, for example. So if you are really dependent on sending either finished goods, raw materials, going between your facilities with rail, and those railroads are in areas that are prone to flooding, then there's going to be delays and disruptions related to increased flooding. So all of these things are important to consider when you think about your company's exposure to climate risk and disruptions. So a good way to look at this, and something that our customers find very helpful, is to think about those risks in relation to your value chain. So maybe it's your own physical assets. Again, maybe it's your suppliers where they're producing things. Maybe it's where your customers are. Maybe it is those logistics routes in between. Maybe it's where your employees live. And to be able to think about not only your consumption habits, but your exposures in those areas. So being able to overlay, okay, we know these facilities use this much electricity. And then we know that grid reliability is X in this area, and be able to overlay this. So we need a lot of electricity here, and the grid reliability is poor. Or we need a lot of water to produce something, and water stress, like the last one that we looked at. It could also be, we are dependent on workers being outside, and where are there those heat stress days, Or maybe when there's high heat days, that's going to drive up our electricity costs because we have to turn on the air conditioning. Or maybe if it gets really cold, then we have to turn on the heat. So all of these different variables can impact profitability, can impact business continuity, and it's really important to understand those risks that your business faces, not only from the perspective of providing transparency to investors, but also for being able to manage and prepare for those risks so that your business is ready to be productive and profitable 10, 20, 30 years from now, or even, as change happens quickly, even, potentially next year or next quarter. So these are things that, again, regardless of what regulation you may be subject to, these are things that your business should be doing anyway, because they matter to the viability of your organization and to the well-being of the communities that depend on you, and those populations that you depend on to prosper.
Wonderful. Thank you, Connie. So now we wanted to transition into more about putting this all into action and completing the actual reporting. So we're curious to know, what is your current biggest barrier when it comes to sort of reporting and complying with these climate rules? And more broadly, like Connie mentioned, with any other climate regulation? Is it more of the availability of your data? Do you struggle with the emissions calculations? Is it more sort of internal organizational related, or how you sort of manage work across teams, or just a general lack of awareness on the requirements? Or are you all set and know what's to come? So we're curious to know how you're feeling about all this. We'll give it 20 seconds again. Perfect. I see some submissions. 10 more seconds. All right. Final 5. Perfect. Okay. Let's see. Data availability is the biggest one, and then also the unclear and requirements. Okay. Yeah. And that's actually a great transition into our next call out. We do see that data availability sort of being a big gap for a lot of our customers. And as you've heard Connie mention throughout this presentation, and as we're likely aware, there are just constant shifts in requirements, asks, timelines, and oftentimes having just sort of one targeted reporting arm as a mechanism isn't enough to sort of build that long-term resilience. So we wanted to talk about at Cority how we provide sort of an integrated approach, providing both those sort of enterprise-grade reporting solutions and sort of that award-winning advisory team with experts like Connie, with deep sort of breadth and ability to support our customers wherever they are in their reporting journeys. And this combination of the two sort of integrated efforts really means we can empower our customers to confidently meet requirements today, improve performance in the short and the long term, and then further build that sort of responsible operations to help build to that sustainable future. So our technology itself is built on a really comprehensive, secure SaaS platform that enables you to manage and sort of acquire data across the value chain. As many of you have kind of noted, that's a big challenge for you now. It also helps to confidently calculate your emissions with our library of over 1 million emission factors, and then again, build that team collaboration. So our solutions are a part of a broader sort of EHS solution ecosystem, meaning that you can join your metrics across efforts, bridging the gap from operational data to broader sustainability reporting. And conjointly, our broad, sort of global advisory services and experts have that deep expertise in supporting our customers to report to over 30 global frameworks and in more than 20 industry sectors. So we understand that reporting is sort of a journey and that one size doesn't truly fit all. So whether you've sort of been measuring reporting on your data for years and years, or you're just starting out, our experts are really able to advise and support in achieving every milestone of your journey. So I just wanted to pause here because I know, Connie, did you want to speak to sort of the survey results a little bit more?
Yeah. Thanks, Isha. So for the data availability, which seems to be the biggest concern, and you're not alone, obviously, from the survey results. And data can be thought about in a few different ways. So obviously there is the idea of sort of primary data versus secondary data versus estimated data, which is really sort of that spend-based. Primary data is always going to be the best, but don't let good be the enemy, or don't let perfect, excuse me, be the enemy of good. So with California specifically, obviously they're saying make a good faith effort. And even with your stakeholders, it's a good idea to start with what data that you have available, and then define those areas where, the caveats or the assumptions, we estimated this data, or we have a gap here, and just being very clear and transparent about where those data quality gaps are. And then potentially just focusing on getting good at one thing versus another is an option. And then, so that would be, for your scope 1, that data could come from direct measurements. If you have, again, if it's a stack or something, then you're going to have things like continuous emission monitoring systems on them. Where there may be fugitive emissions, again, that's going to probably have to be an estimate of throughput versus productivity, where you may have fuel bills. So, if you have a bunch of company cars and it's really difficult to track that, going to a fuel card system could be helpful, so that you have that data more readily available. And I would also recommend, looking at your vendors to say, hey, we're doing this business with you. This is the kind of data that we need for the scope 2. Most utilities can provide you with that data if you ask for it. Again, that can be complicated because you may have a very complex footprint. In this building, we're only floor 15 of a 30-story building. And so again, there are equations and there is guidance for how to estimate your share of that emission. And so there's a lot of different ways. Again, I would recommend, looking through what the GHG protocol has to say, talking to your peers, talking to industry groups. In a lot of cases, industry groups will make data available to you. For example, the American Chemistry Council, people like that will make, if you're in that industry, if you are a member of that industry group, they can help you. Also, like I said, reach out to Cority. We're happy to help you with that as well. And then the emissions calculations and methodology gaps, again, emissions calculations at its very simplest sounds like, oh, no big deal, right? Consumption versus emission factor. But those emission factors can be super complicated and hard to access. And some of them you have to, they're paid data sets, some of them aren't, but you still have to decide which one's appropriate for you. So there again, a trusted advisor can help with that. The industry groups that you're a part of can help with that, or your digital solution provider such as Cority also has that information available and can provide you with that guidance. So there are answers, there are solutions. The unclear on requirements, hopefully this has been helpful to some degree today. Feel free again to reach out if you need further clarity, and those other resources that I mentioned as well, industry groups and the like, can be super helpful. I'm super excited for the 10.5% that said nothing, we're all set. I'd love to know that you guys are in that place, and maybe you can help some of your peers who are, or your colleagues who have some other questions. And again, look to those experts either within your own company or across peer groups that can maybe offer you some advice on how they got to the nothing, we're all set.
Perfect. Thank you, Connie. We'll now transition to sort of our final poll of today's session, more of a tactical question to really understand how folks are currently tackling their reporting. So we're curious to know what tools does your organization currently use? You can select all that apply here to your current state. So is it sort of the internal tools like spreadsheets, or sort of internally built company-specific capabilities? Or do you leverage an external software solution? Or do you take sort of a human-led approach by consultancy? So we're curious to know what folks are currently doing. Let us know now. Perfect. 20 more seconds. All right. Final 10. All right. Final couple. Perfect. Okay, let's see our results. Okay, interesting. So kind of a split actually between internal tools and software, and then we do have some folks using advisory, so that's exciting to see. Connie, any comments from your end?
Yeah, I definitely feel bad for people using spreadsheets. Spreadsheets make me sad. It can be so difficult. This data is ever changing and can be complicated. Spreadsheets are great for the fact that, a lot of these methodologies, GHG protocol is looking to do an upgrade here coming out shortly, but generally speaking, the calculations, the equations themselves don't change a lot. What does change a lot is those emission factors, and choosing the right one and maintaining those emission factors in a spreadsheet can be exhausting and super frustrating. And then it can be really complicated with some of the calculations depending on what your business looks like. So if you are trying, for example, to convert from a non-energy, you're going from an enthalpy to a kilowatt to an emission factor that aligns with that specific location, that can get very difficult. And again, managing that in spreadsheets can be super frustrating. I'm glad to see a lot of people are using software because that can really help. Software has its pluses and minuses, but definitely in terms of maintaining that third-party content like emission factors, keeping those equations updated, being able to put it in a format that aligns with whatever reporting obligation or methodology you're conforming to, be it the California disclosures or CDP or EcoVadis. There's a lot of them, right? So being able to align with those, the software helps with that as well. Advisory support is always great because, again, even within those different buckets, there's a lot of choices to be made. So it's great that people are getting that help.
Perfect, thank you. So Connie, back to you to close us out with some of the key takeaways from today's session.
Sure, thank you. So, one of these I've definitely hit on is that it's really important for your organization, for your own well-being, to understand where those climate risks could potentially impact your ability to continue to thrive. So it is worthwhile to not only undertake that exercise today, but to do it on an annually updated basis to understand, again, where those exposures are. And more importantly, look for those opportunities. Well, maybe not more importantly, but equally importantly is to be able to look at those opportunities where innovation may help mitigate some of those risks. So what can you do to be less dependent on a freshwater resource? What can you do to mitigate or to minimize your energy consumption, be more efficient, which not only improves costs and insulates you against market volatility. We're seeing, obviously, electricity rates go up and up and up. So being able to find those, if you're looking at one site versus another, well, they're generally producing the same thing, but one's using a lot more electricity than the other. So what lessons can we apply from the very well performing facility to the poorly performing facility to reduce those impacts and improve the cost profile? So there's a lot of great reasons to be doing those climate risk assessments. And also, like, not just California, but as we looked at other states and certainly other countries globally are also asking for those disclosures for investors, but also to understand what the overall footprint of the organization is. So lots of good reasons to be undertaking these efforts, not only what you can learn internally, but in order to maintain that market access globally. And, we didn't really talk about a lot of customers in the marketplace are demanding this information as well. It can also potentially, impact your competitiveness where your customers, it's important to them and they want this information. We're seeing a lot of our customers get more and more inbound bids or tenders or RFPs that are asking for that information. And so it's important to keep up on that evolving market requirement.
Wonderful. Thank you, Connie. So now we do have some time for some questions. So I see a few in the chat here, and I'll just start going through them. So, Connie, the first one is, in your opinion, what is the likely outcome of the current litigation?
I'm looking into my crystal ball. I would say that it is probably not going to necessarily be a quick resolution. And it's potential that parts of the complaints are upheld where others are dismissed. So it's not necessarily going to be, a resolution that makes one side happy and the other side sad. It's probably going to be some mix in between. We have seen some precedent historically around success with the compelled speech argument. However, a lot of these entities are already subject to other disclosures of other types of pollutants. So, I would look at it that way. And this is a lot of decisions, but the Supreme Court has given the EPA authority to regulate greenhouse gases. The EPA, where this is going to go, it's hard to say, but the EPA historically has taken the stand that that GHG emissions are very, they're relevant as criteria pollutants, and therefore, if that is all true, and you have to report things like particulate matter, then why would having to report CO2 equivalent be compelled speech where the other is not? I think it can go in a lot of different directions. I think that, if it eventually ends up at the Supreme Court, which probably it will, with the current court, we have seen, a reluctance to support some of the environmental regulations or the authority to implement those or to enforce those regulations. So it's really hard to say. I think from a legal argument, and I talked to a lot of different people about this, not a lawyer, but I think that ultimately some bits are likely to be supported where others are potentially likely to be struck down. So, we'll have to see.
Yeah, makes good sense. Okay. A next question is, so we spoke about this in the presentation around climate risks. So we talked about sort of insurance and sort of resource availability, but are there any examples or specific other examples of climate risks that companies should be thinking about?
Sure. So, we talked about ecosystem services, and we kind of drilled down into freshwater availability, but there are a lot of ecosystem services that are relevant. So let's say, you could be far down the value chain. Maybe you are, you're a beer company, for example, and you're dependent on hops. And so hops have to be grown in certain areas, and there could be increased heat stress for those areas, or increased, wind events, tornadoes, things like that scrape topsoil and make the productivity of those fields reduced, or that, there is less water available or more heat stress, and so that crops don't perform as well. So all of those things, potentially availability of other natural resources, whether it be, again, we talked about forests a little bit, the many things that we're dependent on forests for, or even mined materials. So, there's sea level rise and, hurricanes. So those extreme weather events that would, compromise physical assets or reduce. So say, there's a hurricane and electricity's out for a week and people can't get to work. Those are all going to be things that could potentially impact an organization's ability to, to avoid business continuity disruptions.
Perfect. So I know we're coming up with the hour I think we have time for just a final question for you, Connie, and I think this is a good one to ground us. But so, given all this sort of uncertainty, what should companies be doing? What's kind of your one sort of takeaway that we should give everyone on the line?
Well, I think that there are no regret metrics, right? So things that you should do regardless of where California ends up, because they're good for business. And I think we kind of hit on that a lot here today. So, understanding where those risks and exposures are to your company. Also, though, quantifying your GHG footprint, because a lot of customers in other jurisdictions will ask for that as well. So, it's hard to go wrong with understanding what your scope 1 and 2 at a minimum, what those impacts are, and being able to provide that to stakeholders that care about it. And again, with the understanding, where your material risks are is something that you should be doing anyway, because, just like you would manage any other risk to your company. And if you look at, for example, publicly traded companies in their 10Ks, and they have to disclose a bunch of different potential risks to, one of the main things, like, what if people don't want our product anymore? Well, that's going to, impact our sales, and that's going to impact our returns. So along with all of those other normal business risks, climate risks should be included and thought about and disclosed.
Perfect. And that's a great sort of ending point for us here. So we just wanted to say thank you so much for joining us here today, folks. We hope you were able to learn something new from these regulations and understand some next key best steps. A big thank you to Connie for all your insights today. Just a reminder to please take a moment and fill out the survey for today's webinar experience. We would love to hear from you. So thanks again. Have a wonderful rest of your day and evening. Thank you.